You know, can an exchange be set up at the last minute? Absolutely. If you're at the closing, you're closing escrow, and the client wants to set up an exchange, it's a lot better to stop closing, call up a QI, we'll get documents there in 20, 30 minutes, have them go out for a cup of coffee at, you know, Starbucks or whatever next door, and close it. They tie up their money for 45 days, right? But we have so many people that want to do an exchange, but think about it 2 or 3 days after the fact. You can be a hero to your clients just by setting it up at the very last minute. What we prepare an exchange agreement, assignment agreement, notice of assignment, account setup forms, and detailed instructions to the escrow officer. We also prepare a security instrument, and we'll look at it at the very end. Selecting a QI, the number one thing you want is not the fees, it's not how pretty their website is, it's how are my funds secure? How do you hold my money so I know it'll be there securely? Because we are not regulated anywhere at the federal level as a QI. There's no regulation at all regarding QIs. This is a format here of a multiple property exchange. And what I want you to see here, this is someone selling 3 smaller properties. Let's say those are single family homes, 300 grand. They're going to go into $1 million replacement property. What's important to be aware of is the 1031 timeline starts when property number 1 closes escrow. So if you're selling 3 relinquished properties into 1 replacement, you want to get the first property under contract, but push back the escrow closing date. Then with properties 2 and 3, you want to make sure that your client is reasonable on the price, right? They've got 180 days to do everything. So the way this looks is we take the money, we then buy the $1 million property and deed that back. So this is an example of somebody consolidating. So I'll tell you, I own lots of single family rentals. This is what I'll be doing eventually, right? Because I hate owning single family rentals. It's a lot of work. So eventually I want to go into commercial and consolidate. So that's what it looks like. What most of you deal with is somebody up top who are going to sell 1 property to a buyer, money comes to the QI, and then they buy 3 replacement properties. So 64% of our exchanges, people go into 2 or more replacement properties. They sell 1 and they go into 2, they maybe go into 3, they diversify. That's what most people do. And to be honest, as real estate professionals, what's the advantage to you of this? Commission on the sale, commission on purchase, commission on purchase, commission. You're making 4 commissions with 1 client and you're giving them full tax deferral. So they win and you frankly work with them, and then later on when these properties go up in value, who are they going to come to 7, 8 years down the road if you keep in touch? Hopefully they come back to you because you put them into some good properties and they work with you all over again. So exchanges really are a great way to have repeat business working with your clients. Let's get into this whole concept of parking arrangements. Reverse exchange is where we buy the new property and close on it, close escrow, before selling it. Why do we have to do a reverse? Anybody know why we're doing them?
So the replacement doesn't get away from you.
So it doesn't get away from you. Great example. So let me tell you, I did a reverse personally. It was a few years ago. I was doing model homes down in Arizona. The builder would give me the model home at a discount. I'd buy it, right, lease it back for a couple of years, and he'd sell it subdivision. So I got good rental income, and I got a fully upgraded home at a discounted price. Here's how a reverse works. He calls me at my house 9 a.m. on a Saturday. Scott, got a property, it's located here. Here's the retail price. I'll discount it $60,000. You can buy it for this, and I need you to close in 1 week. And he said, before you answer me if you want it or not, I want to tell you I got 99 other people I can call right now that'll buy this property. Now, I said, yeah, I'll take the deal. This is a true deal. So I bought it, and then I ended up selling a relinquished property as part of a reverse, and then I bought a second replacement property. So I did a reverse, sold, and then I bought a second replacement. So you do a reverse exchange because you have to close escrow on the property you're buying. The seller won't wait around. In today's market, as Anna Marie mentioned, we're up, and this is even over last year, we're up over the last couple of years probably 50, 60%. There are a lot of people that say, I got a good purchase. And I will tell you, it's a great opportunity for you as real estate professionals. You might have a pocket listing that's not out on the MLS. If you can help somebody get into exactly what they want and help them on the sale, you just removed all of the time pressure in an exchange. They're not going to sell and be out there panicking in the marketplace saying, I have no idea what I'm going to get into. and now I face this huge tax hit. So a reverse is a great way to take care of what they want to exchange into and also help them on the sales side. So that's the reverse exchange, and then the improvement, you're either improving or refurbishing a property, and then a reverse improvement, we buy the dirt, make improvements to a property, and then sell the relinquished property. So we do that a lot. We're doing a lot of auto malls with those. Someone goes out to an old auto location, they're gonna go into the new expensive one that's all bumped up and fancy. We buy the dirt, we're building the new building, they're still operating their business. We're doing one right now in Colorado on a feed supply store. They can't shut down their business, but they wanna go to a location that's closer to the interstate. They bought the land as a reverse exchange. We're building their new feed supply store that's 3 times the size. And then they're keeping their business going, and then they're later on doing an exchange out of their current building. So these provide all sorts of planning opportunities. Yes?
Cost of a reverse versus a standard?
Great question. Standard exchange, and I'm not an expert on what all the companies charge in the Portland market, but we charge $700 on a sale, close of escrow, $300 on the purchase, and you can buy 3 properties. So sell 1, buy up to 3 for $1,000. That's what our fees are, which I think are pretty typical. Reverse exchange, our fees start at about $7,500 and go on up. They're very, very complicated. We have to sit on title to the property. Because we sit on title, we've been sued in the past. And we've had to go through hundreds of thousands of dollars of litigation. We had somebody once when we were doing improvement exchange where a metal beam fell on them. They're disabled for life. They sue the owner, that's us. We're now in all this litigation. So these are not cookie cutter deals. We need a phase 1 environmental report on the property. We don't want to go on to that next toxic waste site while we're entitled to it. The IRS requires us to file tax returns in the state of Oregon. And if we straddle 2 tax filing periods, we've got to do 2 different returns. In California, it costs $800 just to form an LLC. So if I have an LLC that sits on title December through March, I now have $1,600 just in filing fees. So there's a lot that's involved. We have a whole special group that does nothing but reverse and improvement exchanges. We call it our commercial division. And so the expertise of those people, and we're doing all sorts of things. A lot of them are for REITs, and they're typically going to be commercial transactions. It doesn't make sense to do a reverse exchange on a $200,000 rental house. The economics just don't work. But on a commercial transaction, if I can buy a building for $2 million and it's really got a fair market value of $3 million, then it might make a whole lot of sense to spend a little more on fee because I'm getting that much of additional equity, built-in equity.
If you already have an LLC.
If you have an LLC, we can work with somebody's LLC.
Fees will be cheaper.
They could be a little cheaper, but when I say a little cheaper, it might be $500 cheaper. We tend to custom quote them. In New York City, we have transfer taxes at the city level. We got to look at every county that we're at and what the transfer taxes are at that county, because these are not cookie cutter type transactions. But what we did get, we got guidance back in 2000, a safe harbor. Does anybody know what the definition of a safe harbor is? Think about what it sounds. It's a safe harbor. You stay in these parameters, the IRS says you're good. So the IRS came out in 2000 with the safe harbor and said, if you follow the safe harbor, the reverse exchange won't be scrutinized and it'll stand up. So we didn't have guidance prior to this point in time. So there are 2 different ways to do a reverse exchange. The first one's what's called parking the replacement property. So the QI is going to have an entity called an EAT, an exchange accommodation title holder. We're going to buy a new property and be parked on title. The big advantage is you don't need all of the exchange equity for this. The big disadvantage is if you have a conventional lender, they're not too keen with making a loan out to Al, right? When our EAT's on title. If they have Al with the loan, they want to have him on title. That's what most conventional lenders do. So let me walk through the structure on parking the replacement property. Here's what happens. First of all, your client has to have the money. They've got to have the liquidity and the resources. So right off the bat, not every taxpayer is going to have all that money sitting around outside cash just to buy a new property. We don't bankroll these as a QI. Your client has to have the resources. Whether they do a home equity line of credit, they borrow against their 401k, we don't care how they get it. They can even sell cannabis, doesn't matter to me, right? Come up with the money wherever you want to come up with the money, but you have to have the cash to loan it to us. They loan the money to our QI. We give them a note for that loan. Then we go ahead and we buy the replacement property. Seller gets the money, and then they deed the property to us. So we're parked on title. Everybody see that? Now, we don't want to manage the property. So we're going to enter into a lease. We're going to triple net lease. We're going to lease the property back to your client. So that's step number one in a reverse exchange replacement property park. So they loan us money, we give them a loan, we give them a note back, we buy the property, we're parked on title, and then we lease the property back to them. They have 180 days to sell their relinquished property. They get that under contract, we are assigned into the contract, we sell that property to the buyer, we get the money, right? Because we get the money, remember they loaned us the money up front, but we have to pay back the loan. So now we pay back the loan that they made to us. So in a replacement property parked format, you might want to write this down, we call this the exchange last format. There's no exchange until the very end. All we're doing is buying a replacement property, and we're parked on title. The whole exchange happens at the very end when we sell the relinquished property. So that's one structure, but if your client has a need for financing, this will work well with an all-cash deal, and it works well with seller carryback. If your client needs a loan, then they're going to be pushed over to the what we call the exchange first format, or park title on the relinquished property. So the advantage is it's easier with financing. The big negative is you've got to get all of your net equity from your sale property into the purchase property up front, because we're doing the exchange right up at the very front. So let me walk you through the sequence of steps. Taxpayer loans money to us, they get a note for that. We buy the replacement property, and we have title transferred directly to them. So they're entitled to the replacement property. On the same day, they deed their relinquished property to us. We're entitled, and now we lease the relinquished property back to them. Everybody see that? When they go to sell, they have 180 days to sell it. We sell the property to a buyer, we get money, and then we pay back the loan that they made to us. So it depends on what your client's needs are and really what their financing is on the deal to dictate, are we going to go with the exchange last format or the exchange first format? So we ask a lot of questions. So Anna Maria and I will ask, what are you selling for? When do you close escrow? What's your equity? What's your debt? Do you have conventional financing or not? These are much more complicated. A lot more moving parts that are going on with these types of transactions. So with those two formats, any questions at all on those two formats? Yeah.
There was a mention that there's been a recent ruling in California that will allow you to extend the 180-day on the reverse.
Yeah. The ruling that you're referring to is what's called Bartel. Is that the one you're referring to?
Sounds familiar.
Yeah. So Bartel is an old tax court decision, litigated actually by somebody out of the Northwest. It was a pre-Rev Proc decision. So I'll try and get technical with you. I've been doing exchanges for all these years. We did reverse exchanges with no guidance from the IRS. We just took our best guess. In Bartel, which is the name of the taxpayer, they did an exchange pre-Rev Proc, so before 2000. It was litigated in the courts, and we got a ruling on it recently. And under Bartel, they were able to have more than 180 days. So I can tell you though, it's really insignificant. The Rev Proc says you can do more than 180 days. You can do an exchange under more than 180 days. It's called a non-Rev Proc reverse exchange. So it can be done. The fees for that start at about 20 to 30,000 and go on up. And I'll tell you why. When you do a non-Rev Proc reverse exchange, the QI, the EAT, we have to have significant burdens and benefits of ownership. There's a tax court decision called DeClean versus Commissioner, and it showed we have to take our own capital and put it in. So now the QI has to put our own money in. And if the property goes up in value, the QI gets the profit. If the property goes down in value, we have the risk. So can you do one over 180 days? Absolutely. But the QI then has to have skin in the game, right? They put their own money in. And if the property goes up in 6 months, they get some profit.
Is
And
it
it's-
usually used for a property you're building or some improvement?
Well, any parking arrangement has to be, so if we go back, and I'll try and make this simple. If you want to do a parking arrangement with no risk, you stay within the safe harbor. The safe harbor says you have 180 days. The other way to do it is you do a non-safe harbor outside of that. And you could use it for an improvement or a reverse exchange. Generally, the types of people that do it are going to be like ExxonMobil does it. When they build an oil refinery down in Louisiana or Texas, they're going to build an oil refinery over 2 years. It's going to be a $400 million oil refinery. They'll do a non-safe harbor, right? Because the cost of the fee of 30, 40, 50 grand is nothing to them. Your average taxpayer is not going to take more than 180 days. Most everybody in this room, my input to you, do a safe harbor 180 days because your chance of an audit once you're outside of the safe harbor is very, very high. How many people here are going to spend 20, 30,000 for a fee? Anybody? I mean, it's possible, but I just don't think it's practical for most people. So yes, you can do more than 180 days, but it's very expensive. It's very risky. Leave it to the oil companies and the big hype, you know. Has Donald Trump done it? I don't know. You know, that's the sort of caliber. People that have billions of dollars swishing around, they've got the appetite for those. Your average investor is not going to want to go outside of the safe harbor, in my opinion. So, but it's the Bartell case that kind of got all this discussion going. Okay, another way to go. We talked about parking arrangement. The improvement is another way to go. Now with the improvement exchange, here's some really key things to keep in mind. We've got some slides on this. You have to, within 180 days, get real property improvements made. So this comes right out of the regs. It says, any additional production occurring with respect to replacement property after it's received by the taxpayer is not the receipt of like-kind property. So some people think with the improvement exchange, I just got to get the money out of my escrow account, right? Get it out of the QI account. You actually have to have the real property improvements done. The regs state any improvements that are done after 180 days are not like-kind property. So here's the example I give you. If I have a piece of land with a big pile of lumber, I have real property with personal property. If I attach the lumber to a foundation, I now have improved real property. For your clients in improvement exchanges, it's very important that they get enough real property improvements done within the 180 days to meet their 1031 requirements. Reinvest the net equity, same or greater debt. You can't just get the money out on day 179 and wire it out and have it qualify. You actually have to have it improved. So that's really important. And that might be a factor. If somebody's going to build, let's say up in the mountains where it's snowy, it might be a little tougher building that vacation home. If we have a tough winter, it could be a variable that you got to take into account with improvement type exchanges. So let me show you the other piece on an improvement exchange. The identification needs to be in as much detail as is practicable at the time identification is made. Now what does that mean in English? It means typically most people send to us the plans for what they're going to build and then a description of the parcel number. So I'm going to build a fourplex on this parcel. But if they end up building a shopping center and not a fourplex, they didn't acquire what they identified. So you're allowed for running construction changes. So if you identify a stucco fourplex and you build a brick one, that's okay. If I have a roof pitch of this and I change the pitch to that, it's okay. So making running construction changes is okay, but you have to acquire substantially the same property that you identified for it to qualify in an improvement exchange. So here's what it looks like from a flow standpoint. Taxpayer sells to a buyer, money comes to the EAT, the exchange accommodation title holder. We go here, we buy the property, they then deed the property, and we're now parked on title, and now we've got a construction management agreement. So we're making the improvements. Your client would oversee this process. They're going to approve the construction draws. So we're not going to decide on the color of the carpets and the fixtures. Your client drives all that with the construction agreement. Within 180 days, we then have the EAT transfer title of the replacement property with the improvements back to the taxpayer. Now, a lot of people ask, how can you do an improvement exchange? You know, this hotel, can you build this hotel in 6 months? Not a chance. Here's how you do construction exchanges. So I want to give you a real life example. Taxpayer sells a piece of dirt, let's say for $1 million. Closing cost of $70,000. They land up with net equity of $930,000. They go buy a property here. They buy some dirt for $600,000. Site work, construction draw for $100,000. Foundation $230,000. Now it's worth $930,000. So their net equity was $930,000. The net equity here is $930,000. They have full tax deferral. We deed the property back to them, and then they do the remaining improvements. So an improvement exchange is great for somebody that's going up in value. They're going to sell for $1 million. They're going to build a $3 million building. We just need to get $1 million done in 180 days. That's really easy to do.
Can they
So-
already own the lot and then just put all the money in?
Great question. Can you already own the lot and just put all the money in? So flip over on your slides here. I almost like to give you $20. That's a perfect lead-in. An exchange of real estate owned by a taxpayer for improvements on land owned by the same taxpayer does not meet the requirements of Section 1031. So Revenue Procedure 2004-51 says, no, you cannot build on a property that you already own. It's got to be a new property. Now, this is the advanced class, so I have all these little caveats. There is a complicated structure where you could create a new leasehold interest of 31 years or greater, make improvements on a leasehold interest, and then transfer that back to a taxpayer. And as I mentioned with the non-safe harbor reverse, this costs a lot more. This is going to be a $10,000 to $20,000 transaction. So it's complicated. There's some guidance with two PLRs that came out in the right around 2003, 2004. So there's a complicated structure to create a new leasehold, make improvements on the leasehold, and then transfer the leasehold back to the taxpayer. But it will only work on a commercial type transactions. Now the question that we got asked earlier, and I think I got on the next slide, Section 1031 is tax deferral, right? Your basis follows you from one property to the next to the next. Section 121 is tax exclusion. It's a better deal. You've got three different scenarios, and I'm not going to unpack them all, but you can combine and jump from residence to rental and rental to residence and vice versa. So your three scenarios, one is what's what I call a split treatment. Well, what does that look like? A split treatment would be if your client lives in a fourplex, they live in one unit, 121, the other three units are Section 1031. They sell it to one buyer and they exclude for the one unit they lived in under 121, and they do a 1031 exchange under the other three units. The other area we see this a lot would be farms and ranches, right? The one that Anna Marie and I are working on, somebody has a little farmhouse worth a few $100,000. The land's worth, $8 million plus. That's a split treatment. So they'll use 121 on the house and Section 1031 on the farm and ranch land. You can convert a rental into a residence. So I do a like-kind exchange into a property that's initially rented, and then I later on make it my residence. This is the one I mentioned earlier. Then you get partial exclusion. You get a ratio of how long you've lived in it over the total ownership time. We got one more twist to it here, and this one's kind of fun. What about converting a residence into a rental? Anna Marie, what's a house go for in downtown Portland? Nice area. What's a home? Nice part of town.
700.
700 grand. Good example. So you live in a house and you're single for 700,000. You move out of it and you make it a rental for 1 year. You lease it out for a year. Then when you go to sell it, you're single, so you live there for 10 years. You put $250,000 into your pocket, right? Because you lived there 2 out of 5 years. But most recently, it was rented out. So now you use a like-kind exchange and you go buy another investment property for what? For $450,000, and you get tax deferral. So you're able to have one property, some you exclude under 121, some you do a 1031 exchange on. So you use two tax codes on one house. So there are a lot of ways to go back and forth. What I'd recommend is, call Anna Marie locally and she can kind of run through the options here and give you some perspectives. But we have a lot of people that jump between rental to residence and residence to rental. It's really kind of a fun tax planning opportunity. whenever you do an exchange, you're gonna fill out IRS Form 8824. And you're gonna have to put on there how long you held the property, when you identified, and then when you closed on it. I don't think Anna Marie covered this. Remember I told you 180 days, it could be more or less. It's less than 180 days. When? Well, if you've got to close, if you close at the end of December and you file your tax return on April 15th, what do we file this year? April 18th, right? Why? Because of a little weird carve out, because it's a holiday in DC and that overrides federal law, so now we got to bump back to April 18th. So that's less than 180 days. Why would we ever have more than 180 days? Anybody know? Presidentially declared disaster area. If a county, if your client has a property or tax records in a county that's considered a presidentially declared disaster area, you get a 120-day extension on your 45 days and your 180 days. So when we've had hurricanes in Florida, or the one on the East Coast, in my state of Colorado, we had some big fires, and we had some flooding. They were presidentially declared disaster areas. You get a 120-day extension on your identification and your exchange period. So the exchange period can be less than 180 days, it could be 180, or it can be more. And keep in mind your 180 days go through calendar days. So if your 180th day is Christmas, you better identify before the holiday. You're not going to get any leeway for that. So that's what you do on Form 8824. Now let's get into a fun area, recent developments. And I could talk for this, Anna Marie knows, for hours and hours. I will consolidate it to about 8 minutes. In Washington, tax reform is a big issue. And so I don't even know where to start on this, but I'm going to give you the turbo crash overview. Back historically, I've been doing this for 3 decades. We've looked at the lost tax revenue with exchanges of somewhere between 10 to 15 billion over a 10-year period. So it's called a tax expenditure. It's the IRS speak. They look at a tax break that we think is good, and they call it a cost. That's how government looks at it. So anyway, that's really twisted in my area. Well, way back in 2014, they bumped the number up to $41 billion. And all of a sudden, instead of it being a 10 or 15, they said, oh, exchanges are costing us. We have all these people doing exchanges, more revenue. So as a result of that, and for tax reform, they're trying to get the corporate rate down from 35% to a lower rate. They're looking to reduce individual tax rates. And all of a sudden, from 2014 on, people in government started looking at 1031s. We had a proposal, what's called the Camp proposal in 2014. He was a Republican. He proposed eliminating exchanges. The head of the chair on the Senate side also proposed eliminating exchanges, Max Baucus out of Montana. Kevin Brady now is working on a tax reform bill. So Kevin Brady's chair of the House Ways and Means. He's basically Paul Ryan's right-hand man and doing whatever Paul Ryan says. Orrin Hatch is also working on a tax reform bill. He's also looking at something what's called corporate integration, and all that says is they're trying to integrate the corporate code and individual code to make them more aligned, that we don't have individual rates of corporate, that we look at them more holistically. So that's what those two are looking at. Well, how does that affect 1031s? Well, there's something called how many people know about the blueprint? Looks like we got a weird order here. I'm going to go ahead right here. Okay, we got the House. It's not on here. All right. Last summer, the Republicans released what's called the blueprint. It's 25 pages long, and they look to redo our whole tax code. In the blueprint, they've got a few provisions. Number one, they have what's called a border adjustment tax, a BAT, that they want to charge people that import a 20% surcharge, and if you export, no tax. Right now, they're saying the projections are that'll cost the average American $1,700 in new taxes. In my opinion, it's an awful thing. It sounds good, right? Be pro-US. We're all going to be paying more for our clothes, our shoes, our gas, our groceries. At the end of the day, Kevin Brady says this is going to create $1.2 trillion in new taxes. Who's going to pay those taxes? Everybody. And it's a regressive tax in that it hurts the people that are middle class and poor or more, because the rich person, proportionally, it's going to be less of a burden to them. So so the first part of the blueprint was adding this border adjustment tax. Next, They want to do away with 1031 exchanges and replace with what's known as full expensing. Does anybody know what full expensing is? It's depreciation on steroids, okay? A commercial building you depreciate over 40 years, a residential over 27 and a half. Full expensing is you take all of that tax write-off in year one and offset your ordinary income with it. And then you've got unlimited carry forwards. So the blueprint proposes full expensing. So for real estate investors, you get full expensing, but you'll no longer be able to deduct your mortgage interest on investment properties. They get rid of that. You'll no longer be able to deduct the state and local taxes. They're going to get rid of that. So there are a lot of things with this blueprint that are very controversial, and I won't get into the politics of it. Kevin Brady loves it. Paul Ryan loves it. I think there are a lot of disadvantages, but the problem for us is they propose as part of this blueprint to get rid of Section 1031. So we've had Section 1031 in the tax code since 1921. Trump is looking to go down to 3 brackets, and so is the House. What Trump wants is he wants a 15% corporate tax rate. He's fine with capital gains being at 20. The Republicans want a 20% corporate tax rate, and they want to have capital gain taxes be 1/2 of the new tax brackets. Both of them want to get rid of the Affordable Care Act and the surtax, that net investment income tax. Well, 2 weeks ago they tried to do that, and how did that go for the Republicans? Not so good. They fell flat on their faces. They couldn't get together and do the big repeal and replace. Right now today, Donald Trump is working hard, him and Mike Pence are working very hard. Why do they need to get the ACA repealed? If they don't repeal it, they have to score tax reform with all that tax revenue. So the tax revenue that comes off of this surtax here, it's about $1 trillion over 10 years. So they have to, a tax reform, include that $1 trillion, and that becomes a higher baseline that they then have to either get rid of another $1 trillion of tax benefits for. So it makes tax reform very hard. So they're going to have a very hard time getting tax reform done unless they can do the healthcare reform, if that makes sense. And I'm probably speaking around in the weeds here with all sorts of stuff. Let me get you to the kind of the key issues with this. National Association of Realtors, so your organization here, did a study in 2015. 63% of realtors participated in 1031 exchange. 40% of realtors said that without Section 1031, their deal never would have happened. And 56% said that without an exchange, it would have been smaller in scale. There was a study done by Ernst & Young that said if you get rid of Section 1031, which brings in $4 billion, the net impact on the economy is going to be somewhere between 13 to 18 trillion negative downturn in GDP. If you don't have Section 1031, title companies aren't going to have as many transactions. You're not going to have as many commissions. Lenders are going to do fewer deals. The home property inspection, the guy that comes in and paints a house before you sell it, everybody up and down that food chain, there are going to be fewer of them. So the bottom line here, if you're looking for more information on this subject, is a website called 1031 Tax Reform. You can go there, and if you'd like to share your opinion with your congressional representatives, I've actually met with people, not with Oregon, but with Washington. I'm back in DC every month now. Go to 1031 Tax Reform. It's a great resource on this particular issue. A few recent developments, a private letter ruling. We talked about where we're going to have related party leasehold exchanges. So this gentleman's question about building a property you own. On Blancardio, this is one where somebody used an attorney as their QI. That's okay to use an attorney, but the attorney was their son, their related party. Not a really good idea. This one I like. So Adams versus Commissioner is one where somebody rented to their son. You can rent to a family member, just treat it at fair market rent, and treat it like we would any other landlord relationship. The most important thing you want to do when you look at QIs is do due diligence on the funds. How is my money held? And how's that money being held by the QI? There have been some huge bankruptcies. So you're familiar with Summit Exchange up in Central Oregon, some of you are. The biggest bankruptcy was one called Land America Exchange, $420 million. There's another one called 1031 Tax Group, $132 million. Ed Oken, who owned the company, is serving a 150-year prison sentence in Florida. But I'll tell you, if you're one of those investors where you lost 132 million, you could care less about his prison sentence because you just lost your life for retirement. That particular one affected a company in Colorado, and I saw investors testify in Colorado. People that lost millions, their whole retirement planning were gone because of an unscrupulous QI. So the most important thing you want to do is look at how is my money secured. Let me give you some questions to ask. Does the QI offer the written backing of a large entity? What do they do to secure the money? There are a lot of independent companies up here in the Northwest, and you're just trusting them with your money. Do they have a large parent in some way backing them to back up the money? What's the financial rating and balance sheet? And where is the money deposited? Let me tell you the number one thing you want to look for. Does the QI offer a separate, segregated account? You don't want the money commingled in any way. You want a separate account for your client. At Asset Preservation, we require your signature to open up an account, and then to move money requires our signature and your client's signature at the same time. So a commingled account is where you get into trouble. You want a separate account. They can offer a qualified escrow account or a qualified trust account, certainly. Most QIs have some bonding. You know, we have bonding. We have $13 million. We have a lot more than we hold in that. We're sitting on billions and billions of dollars right now, today, billions of dollars in our possession. With the backing of our parent company, which is Stewart Title, who's been in business for 120 years. And regardless of who you work with on title and escrow, they'll stand behind the money, which is really nice to have a publicly traded company. Finally, wrapping up, if you've got questions, you know, we tried in 3 hours to cover a lot. Anna Marie's information's up there. She's Anna Marie at API Exchange. She's here local, and she'll answer your emails after business hours, answer your questions. We just want to be a resource to you and your clients. And our website, API Exchange, has a lot of information on there. So feel free to take advantage of that. And then, Anna Marie, why don't you kind of go through the process for getting the certificates and what we'll do to wrap up.
For those of you who are requiring Washington credit hours, I have your certificate here. But I must have this sheet before I can give it to you for our own requirements for the state of Washington. So.
And what about Oregon?
And Oregon, let me tell you, Oregon,
Okay.
Washington, I need you to sign it in both places, so it's on the same
So
level.
Washington, come up here, Oregon back there. Thank you very much for your time. We really appreciate it. Thank you.